WATL Television brought consulting economist Ed Jones aboard to help us understand the enormity of the scandal. Ed has been an economic advisor to the U.S. Justice Department, so he understands what the department faces. He was also a consultant to the Federal Sentencing Commission, studying more than 2,000 cases of corporate crime. Ed, $300 billion is not just the stuff of Washington fantasy, is it?
No, Dick, it isn't. That $300 billion is about equal to 1 year's defense expenditure, or the cost of the entire space program over the next generation. As the late Senator Everett Dirksen once said, a billion here, a billion there, pretty soon it adds up to real money. Well, the savings and loan bailout is $50 billion here, $50 billion there, and it's a bill that taxpayers are going to have to pay.
And there's good news and bad news about that. The good news is that Georgia has strong financial regulations and did not experience the problems Texas, California, Florida, and other states with lax regulations did. 36 states experienced at least one bank failure between 1986 and 1988. Georgia was not one of them. The bad news is that Georgians, you and I, we're all going to pay for the savings and loan bailout just like everyone else. Texas alone will require over half the bailout money.
This man-made disaster is due to legislative looting. Congress and state lawmakers elsewhere remove sanity from a fragile financial system whose foundation is based on confidence. In essence, they created very risky operating opportunities for traditionally conservative home lending institutions that would be backed by an unlimited supply of certain, guaranteed federal insurance funds. Then, to make matters worse, in the name of deregulation, congressional and regulatory oversight of the savings and loan industry became lax. Wrongdoing received only slight punishment, if any at all. Corrective action was delayed at what has turned out to be enormous cost to taxpayers. And all of this has been shrouded in secrecy and lack of attention, really what can only be called a fundamental breakdown in accountability and ethics. The Attorney General was right when he said last Thursday that this could be the nation's, quote, biggest white-collar swindle, unquote. It is. And today, Dick, we're dealing with a new type of robber.
You know, the traditional bank robber carries a gun. He walks in the front door and up to a teller and demands that the cash be put in a bag. Last year, according to the FBI, there were 6,600 bank robberies, with robbers taking an average of about $2,900 an incident. That totaled about $19 million. Bank robbery is a federal crime. So the FBI has a high capture rate of bank robbers, and about 95% of those convicted go to jail for an average sentence of 13 years.
Now, in the 1980s, we have a new definition of robber, one whose weapon of choice is this, the pen. The ink was hardly dry on the 1982 savings loan deregulation law and on laws in states like California and Texas when financial opportunists and con men moved in to take over or set up savings and loans as personal money troughs. Unscrupulous operators had newfound freedom for real estate scams because federal regulations now allowed 40% of loans in non-residential real estate. And in some states like California, they could invest in anything at all. In California alone, in 1983 and 84, 200 new savings and loans were created. One Californian, when he heard about California's relaxed regulations, was reported to have said to himself, "My God, this is what I've been waiting for all my life."
Well, Ed, you're a specialist in deregulation, so you know the 1982 federal deregulation law changed the community-based spirit of savings and loans. Before deregulation, a broad base of shareholders provided security and accountability in thrift institutions, and they reflected the traditional community nature. In Atlanta, this tradition goes back to at least 1895. $2 million is invested in building and loan societies, and this statement carries its own inference as to the frugality and economy of that class of small owners who find this system so helpful in their efforts to secure homes. Savings and loans were the principal vehicles of American home ownership. The classic film, It's a Wonderful Life, was built around exactly that theme.
You're thinking of this place all wrong, as if I had the money back in a safe. The money's not here. Well, your money's in Joe's house. That's right next to yours. And in the Kennedy house, and Mrs. Maitland's house, and 100 others.
In my opinion, one of the most serious changes in federal savings and loan regulations was lowering the number of shareholders from a minimum of 400 with no share larger than 25% to one who could own all the shares. One of the reasons that Georgia has not had the financial institution problems that other states had is that it did not lower its requirements. It kept the number of shareholders high with the maximum size of share low. This change in savings and loan ownership, along with the drop in capital for operating, eliminated checks and balances and opened the door to fraud, insider abuse, and other misconduct.
Many of the new owners favored risky commercial real estate loans in place of traditional mortgage lending. S&Ls that retained traditional conservative mortgage lending practices and introduced adjustable rate mortgages are the most profitable today, but they're being penalized by bad apples in the industry. For the savings and loans that have failed, the bad guys did what they do best.
The controller of the currency found that in savings and loan failures, only about 10% could be attributed solely to economic factors, such as collapse of energy prices in the Southwest and weak real estate markets. A number of other surveys show that fraud, other misconduct, and ineptitude were responsible directly or contributing causes in the rest of the failures.
Deregulation of S&Ls opened the door to fraud and misconduct, and lax regulatory oversight and prosecution of wrongdoers unleashed risky investments and wanton spending at a furious pace beginning in about 1983. As Dick Francis states in his new novel, crime was simply a way of life. If laws are inconvenient, ignore them. They don't apply to you. Well, that describes the unscrupulous operators of S&Ls.
Based on my experience at the U.S. Sentencing Commission, white-collar criminals get relatively light sentences. Few owners of defunct or insolvent savings and loans have been criminally charged. 40 years ago, it was a different story.
Where's that money, you silly, stupid old fool? Where's that money? Do you realize what this means? It means bankruptcy and scandal and prison. That's what it means. One of us is going to jail. Well, it's not going to be me.
But that was then, and this is now. Of those that have been charged and convicted, 172 between 1983 and 88, only about half go to jail, and the sentences are relatively light, about 3 years on average. But experts, like former U.S. Attorney Robert Bonner in Los Angeles, state the obvious. In the long run, the most significant deterrent is criminal prosecution, conviction, and a meaningful jail sentence. The Attorney General announced last Thursday the addition of 400 investigators and prosecutors to handle the nearly 8,000 bank fraud matters that have been referred to the Department of Justice.
We are today announcing plans for a 27-city attack on savings and loans fraud through the deployment of more than 400 additional federal prosecutors, FBI investigators, and accounting personnel. Our goal is to bring to justice all those who have sought to capitalize on the American dream of home ownership by cheating its citizens out of their savings and destroying the financial solvency of institutions designed to serve them.
But Dick, it may be too little, too late.
Ed, what I don't understand about this is you've got 8,000 bank fraud cases, you've got people looting these operations, you've got people investing in all manner of risky speculative real estate deals instead of traditional home mortgages. How did all this go undetected for so long?
With relaxed regulations, owners of savings and loans could create assets with a stroke of a pen. To raise money to invest or lend for creating assets, savings and loans had to attract deposits. In 1980, as a way of alleviating interest rate squeeze brought on by inflation, banks and savings and loans were able to offer market rather than fixed interest rates to attract deposits. Savings and loans competed for funds, and funds were moved to where the highest interest rates were offered, generally by deposit brokers. These deposits provided the fuel for the investment fire that raged in the mid-'80s after deregulation.
Now, some of this sort of thing gets real complicated, and I think that's why bankers wear three-piece suits. But we're going to try to show you some of the ways in which the theft of funds was made easier. First, there were interlocking partnerships. Owners of S&Ls could lend money to their own companies for whatever purposes they deemed appropriate. Opportunities for conflicts of interest were boundless.
There were land flips. With several strokes of the pen, deeds changed hands, artificially raising the price of the property each time. Assets of value that showed on S&L books were worth significantly less and sometimes worthless.
There were false appraisals. Value frequently was determined by an appraiser who may have had insufficient knowledge of market conditions or who simply falsified documents. Many failures showed instances where no one bothered even to do an appraisal.
Another example is accounting gimmickry. Books sometimes were so complex that it was impossible to assess true conditions of savings and loans. Networks of fraudulently run savings and loans developed so-called daisy chain schemes to move assets and deposits back and forth before audits and examinations to hide their true conditions.
There were paper profits, which is what I sometimes think I've got in my bank account. S&L owners engaged in rollover of notes. Fees and interests on a loan were never paid. They were just added to the loan. The S&L treats the fees and interest as earned income, but when it's due, the loan is refinanced and the process just continued.
There were inexperienced lenders. Traditionally, savings and loans had dealt solely with relatively straightforward mortgages, not sophisticated non-residential real estate deals, junk bonds and the like.
Well, if money's the root of all evil, greed is one of the 7 deadly sins. And many savings and loan owners live lives of excess that can only be imagined. Corporate jets, artwork, expensive homes, jewelry, travel, parties, all a benefit to the owners at the expense of the trusting depositor.
Then, of course, there's lack of regulatory oversight. In the spirit of deregulation, there were fewer examiners. The examiners were inexperienced in dealing with a new breed of savings and loan investments, and it took often 2 years or more to schedule an examination. In addition, the turnover rate of examiners was high, over 30%, because their salary was anemic for the job required in tracking a network of camouflage paper trails. Setting a deliberate course through a house of mirrors would have been easier. And in states like California and Texas, regulatory action was only after the damage was complete.
You know, Ed, we talked at the beginning of the broadcast about natural disasters, hurricanes and earthquakes, and in those we know immediately how to count the damage, how many homes were destroyed, how many cars were damaged, that sort of thing. But this is a man-made disaster. We've shown folks how they did it, but what does it all add up to?
Well, Dick, of the missing money, 1/3 to 1/2 has been stolen. A significant but uncertain percentage of the rest was in assets that will have negligible value, such as barren desert land, uninhabitable housing, particularly in Texas, and items for which there's no market or a very narrow market, such as the 53,000 square foot house with 14-car garage, Olympic-sized pool, ice skating rink, and beauty salon in warm Phoenix, Arizona.
Screening of S&L owners was lax. A man named Schwab became a major stockholder in 2 federally insured S&Ls. At the same time, he was being denied a gambling license by the Nevada Gaming Board. Why bother with gambling when you can win with an S&L? S&Ls operated on a sea of paper. 96% of Vernon Savings and Loan loans were in default when it was closed in 1987.
Lending policies were generous and occasionally did not rely on credit and income checks. 2 partners were lent $200 million by San Marino Savings and Loan over a period of 10 months, even though their combined income was less than $30,000 3 years earlier. Congress and regulators in early 1980 created conditions for abuse of savings and loans, especially dropping shareholder requirements from 400 to 1, lowering capital requirements, and permitting risky direct investments without at the same time enhancing regulatory strength and examination.
Congress tried to patch up a problem in the early 1980s that needed a thoughtful, careful response. The financial system by nature is risky and fragile, operating efficiently when it has the confidence of all the participants. What Congress did was simply cover all new risky opportunities that it created with a 100% taxpayer guarantee. Federal Savings and Loan Insurance Corporation Insurance, FSLIC. FSLIC Insurance had been around since the mid-1930s, guaranteeing depositors money up to a certain amount. That amount was raised 150% from $40,000 to $100,000 without debate, and that has certainly raised the ultimate cost the taxpayer will bear for the S&L bailout.
The breakdown occurred because in the deafening silence in 1987 and 1988 from regulators and Congress, unscrupulous savings and loan operators who were playing with other people's money, the taxpayers' money, could no longer keep the lid on the problem. Let me tell you how playing with other people's money works. You deposit $1,000 in a savings and loan, for which the savings and loan pays you interest. To earn that interest and cover its own operating expenses, the savings and loan invests, traditionally in home mortgages, more recently in real estate ventures, bonds, junk bonds, etc. If the savings and loan invests wisely, then it's profitable. If it doesn't invest wisely, it has to use its capital to cover losses. But in either case, your deposit is protected by the U.S. government-guaranteed insurance, FSLIC. If the savings and loan business fails, then insurance gives you back your money, including interest, up to $100,000. If the insurance fund fails, then the U.S. government, really the taxpayers, you and me, come to the rescue.
In the 4 short years after deregulation, fraud, other misconduct, inexperienced operators, and the collapse of energy and real estate prices brought savings and loans financial system to collapse. The response of Congress and regulators was delay and silence. Just when the country needed the best regulators money could buy, those regulators were stopped cold in their tracks by some of the best politicians money had bought.
As a resident of California, I am particularly angry with Senator Cranston. I am a constituent of his. For a sizable campaign contribution from Mr. Keating, he was willing to sell his influence. Mr. Keating is a resident of Arizona, and Cranston could not even count on him for a vote. I gave Senator Cranston something much more precious than money. I gave him my vote, and I gave him my trust. He let me down. I called his office twice. I wrote him letters. He did not even have the decency to respond in any manner. Not even a form letter saying, "I'm looking into the matter." As the evidence unfolds in this fiasco, it is clear to me that without the help Keating received from Cranston and others in government, he could not have done what he did. Finally, I must say, when you look at the mountain of documents and papers in this investigation, I beg you, do not lose sight of the victims. We are not just numbers. We are out here with no voice until you give us that voice.
Mrs. Lampell is just one of many who's creating a serious political problem for Senator Alan Cranston, the senior senator from California. And as the victims of this mess, as they come forward, as their stories begin to be told, Senator Cranston and others are going to have serious election problems in addition to the ethical and political problems they've got. What I don't understand is that while this clock was ticking, while costs were mounting, why did these congressmen and senators seem to do nothing?
Congress underestimated the costs of solving this problem. In early 1987, the costs were $15 billion. By the end of that year, $23 billion. 6 months later, $35 billion. In October of 1988, $50 billion. At the end of the year, in December, $85 billion. By February, when the Bush administration was discussing a bailout plan, $90 billion. By August, when that plan passed, it was $164 billion. Now, in December of 1989, the estimated cost is $300 billion or more. Costs are still being underestimated. Congress will have to come up with $50 billion more in working capital in early 1990. FSLIC insurance was judged sufficient to handle the early estimates of loss, but not now.
There was another important wrinkle. Industry lobbyists and regulators and S&L owners pressured regulators and Congress to do nothing. After all, who wanted to deal with the problem in a presidential election year? No one expected the looting of the system. Clearly, ethical issues have been raised. No one expected so many assets would be artificially valued. No one expected the waste of deposits on frivolous or extravagant expenditures.
You wouldn't mind living in the nicest house in town, buying your wife a lot of fine clothes, a couple of business trips to New York a year, maybe once in a while Europe.
I like it, Ed. You can't buy a great American like Jimmy Stewart for just a couple of trips to New York or some clothes for his wife, but I suspect that in the last 40 years, with inflation and all, and with deregulation, that the carnage from the looting of the savings and loans has gone up in price and value a good bit. What kinds of things are we looking at today?
Indeed. Here are a couple of celebrated examples. Donald Ray Dixon's $68,000 one-week culinary trip to Europe. What his wife called the culinary fantastique.
Wait a minute, this guy was food tasting?
Food tasting on depositors' money.
68 grand.
Executives of Sunrise Savings and Loan in Boynton Beach, Florida, spent $30 million in funds that were diverted from capital and construction loans for Lear jets, the corporate helicopter, a small 116-foot yacht, a tiny 26-carat diamond ring, exotic autos, and other things. And just last Friday, regulators issued a cease and desist order to a Miami thrift whose chairman used depositors' money for $29 million of artwork that were stored on the walls of its chairman's home.
It was either good artwork or it was a big house. Congress acted in August of 1989 with a $164 billion S&L bailout. It provides for more prosecutors, announced by Attorney General Thornburg last Thursday. It extends the statute of limitations on criminal activity, requires tightened capital standards that also went into effect last Thursday. It tightens audit standards, mandates higher premiums for deposit insurance, and requires hiring of more examiners.
In the last several weeks, I've met with regulators and prosecutors in Washington, D.C. and in Georgia. New organizations created by the August 1989 law pick up the pieces of the Federal Home Loan Bank Board, FSLIC, and other agencies. They, I am convinced, are making diligent efforts to clean up the mess and prosecute fraudulent operators.
But I guess the question, Ed, is it enough? It doesn't seem to me that it is.
No, it's not enough. Costs continue to escalate. The fundamental assumptions underlying the August 1989 law are not realistic. For example, cost estimates of the bailout assume deposit growth, but the industry has been experiencing record outflows through the third quarter of this year. Sale of assets, particularly in the Southwest, will not generate sufficient working capital or recompense. Requirements to sell at 95% of market value does not reflect book values, but actual market conditions, which in some affected areas are weakening or negligible.
You know, resources for prosecution are also insufficient. Bank fraud cases are extremely complex and sometimes subtle. Investigators and prosecutors frequently are not trained to work in these areas. Criminal referrals are escalating. For example, 434 in 1985, 6,000 in 1988, and 8,000 now. The $50 million provided for new prosecutors and investigators in the August 1989 bill will have to be boosted.
Economic conditions such as interest rates, energy prices, real estate prices, confidence of depositors in savings and loans and banks, and general economic growth will affect the ultimate cost of what the savings and loan bailout will be. Regulators must mitigate potential adverse reactions by strengthening capital requirements and perhaps creating risk-based deposit insurance. They also must enforce the laws that punish certainly and swiftly fraud and misconduct. Lack of rigid enforcement of generally accepted accounting principles by accounting firms and shrouding unacceptable financial performance in secrecy is a breach of trust with the public and has caused a raid on the Treasury of unprecedented magnitude. This condition must be corrected.
Public policy was undermined by lobbyist dollars and regulators who were cheerleaders for the savings and loan industry. Political influence has been bought in the name of constituent service. You know, it's not all that different from what happened years ago in that role made famous by Lionel Barrymore. A lot of the savings and loan people recently thought they owned their congressman.
Look at it.
Congressman Blatz is here to see you, sir.
I'll tell the congressman to wait.
You know, and Ed, as a lot of the headlines of today show us, a lot of congressmen were willing to wait. It's infuriating because this thing has just steamrolled over us. What do you think the average citizen can do? Now, Georgia hasn't been that badly affected. We should say that over and over again. But what can the average citizen do? Because after all, each of us is still on the hook for $1,500.
Yeah, the average citizen can become better informed. Become better informed by looking at a variety of books on the savings and loan bailout and articles in major newspapers. A lot have been published recently, and at the end of the program, we'll list several for your consideration.
You can write to your congressman and senator to insist upon accountability for their actions on this problem. You can insist that costs be accurately reflected on the federal budget. Insist that numbers of and pay and standards for examiners be raised. And insist that adequate funds for additional investigators and prosecutors be appropriated.
Having worked in the Department of Justice and at the U.S. Sentencing Commission, I can tell you firsthand that investigators and prosecutors rely on your cooperation to make successful cases. If you know of any criminal activity or other wrongdoing of savings and loans, contact your local office of the FBI or U.S. Attorney.
Finally, Georgia has a progressive but sound regulatory system. But financial institutions compete, so you need to familiarize yourself with its lending and investment activities. After all, it's your money, whether it's in savings deposits or in tax dollars. Not all of us are old enough to remember when the film It's a Wonderful Life was a big hit, but all of us, I think, are old enough to remember when we could trust our savings and loan, when the savings and loan institution would give us a premium in return for our money, and we could trust them to take care of that money and invest it wisely. It doesn't seem to work that way now. We've got a sort of reverse toaster theory at work, I think. What about the enforcement end of it, Ed? That's your area of expertise. Are the government's priorities straight?
Well, last year, then Attorney General Meese diverted some prosecutorial travel dollars into the anti-pornography crusade. Congress, in the bill it passed earlier this year, earmarked the $50 million for prosecution of bank fraud, period.
And I think it's also worth remembering, let's hope that they do that, but it's worth remembering that this is, at root, a political story.
Absolutely.
It was the S&Ls that got the House Speaker, Jim Wright, in trouble and eventually got him out of Washington. And now we have the well-publicized investigations of 5 U.S. senators for their dealings with the Lincoln Savings and Loan and multi-million-dollar campaign contributions. And I think that ought to keep the pressure on regulatory agencies and on Congress, those kinds of abuses, to see that it doesn't happen again, and for heaven's sake, that our banks are safe.
Yeah, as an economist, I can say the bottom line has to be accountability.
Well, we hope we've been somewhat informative tonight. We hope we've shed some light on a scandal, and again, it is one that has basically missed the state of Georgia because Georgia's state policies are tougher than in most of the Sun Belt. We hope we've informed you. We've enjoyed being with you tonight. For Ed Jones, I'm Dick Williams. Good evening.